Hey everyone, Justin with Deep Dive Stocks here, and today we're going to be looking at a method for trading that I utilize in order to keep my thoughts in order, to know what I'm trying to capture, and to keep an eye out for the things that can go wrong with my portfolio positioning. So let's go ahead and get started. So a lot of people ask me, or at least it's a common theme, they kind of want to know what I'm thinking or how I'm working through a trade. And I thought that instead of just giving a ton of examples and maybe some, bits of this in this trade, this is why I did this, or in this trade, this is why I did this, I thought I would just share the system that I utilize. And this is the system that I use for every trade, every time I enter a position, and every time I'm looking to see if I need to exit a position. So just real quick, I think that having a system is very important. You should structure your trade so that you enter under the same context and you exit under the same context every single time. Developing a system and developing a standardized way of doing things helps eliminate a lot of the factors that may be impeding you becoming a successful trader. So I think it helps organize your thoughts, especially when you're looking to enter a trade. You need to know, did I cover all my bases? Is this a good idea? It helps manage risk. So a part of that process is going to be looking at what risk this position can give your portfolio, and if you need to protect against that risk or not, or if you can afford that risk. And lastly, I think it helps you actively working through the system. It makes you think and plan every step of the way. And it also helps you when things aren't going right. Well, you've already kind of anticipated that this might be a potential outcome. So we already have contingency plans and backup plans in effect. And so we can exit the position, and hopefully do so without too much of a loss to our portfolio. So the system that I use is EEP-JAWL. Pretty exciting. I tried to make it as easier to say as possible, but didn't happen. So EEP-JAWL stands for expectations, and this is going to be, what do I expect the stock to do, right? Do I, pretty obvious, do I expect it to go up? Do I expect it to go down? Do I expect volatility to go up? Do I expect volatility to go down? So on and so forth. But actively thinking about it, what is this stock going to do, and maybe over what time frame is it going to do it? From there, I look at the exposures. So what exposures do I want in order to profit from this expectation? Or what exposures do I not want in order to profit from this expectation? Maybe I want to optimize my exposure to delta, or optimize my exposure to theta while minimizing my exposure to delta, right? And this is where I actively, and for almost all trades, maybe not scalping, but I don't do those that often, I physically write these down. Then we move on to possibilities. So what are the possible styles of options trading or the configuration of options can I purchase or sell in order to capture these exposures to profit from my expectations? From there, once I have a list of possibilities, I go through the justifications for each one of the possibilities, weighing out their pros and their cons to figure out which one of the possible options plays is the best suited and best tailored for my risk reward ratio, which is kind of something that you as a trader need to and will develop on your own. And then from there, I write down, okay, so now that I have the list of possibilities, I write down the justifications for each of them. It's time to either choose and then list the things that can go against this trade, and actively having a list so that you, in the moment, don't get surprised if something happens. Like, hey, I purchased a call on this stock and I woke up and it's down 5%. Ugh. Well, when you went through this step, you saw that one of the things that could go against this position is if the stock experienced a sudden decline in price. So you're kind of mentally already prepared for it, and all right, I said this is one of the things that could work against this position. Unfortunately, it happened. I need to bow out and exit my position. And it's just that straightforward. From there, I list what I call the winning criteria. And this is, I think, a little paradoxical for some people, but the winning criteria isn't the profitable criteria, right? There's the two kind of main steps in trading in the market is getting the good handle on the tools to be able to predict price movement, and then being able to get a good handle on the tools to execute your trades to profit from that price movement. I'm typically more interested in, and the thing that I think is more difficult to cultivate is the predicting of the price movement, right? So I want to know what are going to be the things that say, hey, your prediction was correct. Now, maybe, unfortunately, I didn't execute my trade well enough. I set the wrong expiry, or I purchased at the wrong strike. But at the end of the day, if whatever's in the winning category, if it happened, then I know that my thinking, my train of thought was correct, but maybe I didn't execute that well enough, and that's pretty simple to refine, right? And on the flip side of that token, we have the losing. So what are the things that just indicate, Justin, you were off completely about this stock? It did almost a complete opposite of what you thought was going to happen. And these are the criteria. And so this tells you, you really got to refine. You got something to work on here in terms of your ability to predict price movement or predict volatility movement or so on. So let's look at a few examples and just a handful to get a grasp of this system. But I think you'll see that it's pretty straightforward. And in some of these examples, we're going to start pretty basic and then move to a bit more intermediate. The goal necessarily isn't to go over the types of options plays, or we're going to talk a little bit about like the Greek exposures, but really just like the flow for how I work through going, looking at a stock and coming up with an idea of what the price is going to do, and then all the way down to, all right, how am I going to profit from it? And then, as we saw, what are going to be the things that tell me that I need to bail on this position? As usual, we're accompanied by our friendly neighborhood trader, Sally. She helps us. We just kind of watch her trades. She's a really good trader, so sometimes, we'll punch up and make fun of her a little bit. But overall, Sally is a really good friend. She pops up a lot in our primers. And so let's see what she's got going on. So currently, Sally believes that a stock X is going to go up 5% over the course of the next month. And naturally, she wants to profit from this. So we start with our good old friend EEP-JAWL. And our expectation is that the stock is going to go up 5%, right? Like, that's not too surprising. The exposure we want then, since we're doing an options play, is we want that long delta exposure. We want the value of our position to increase as the value of the stock increases. And we have a few possible, why won't you click? We have a few possible options plays that we can employ in order to benefit from this. We could do the standard long call. We could just purchase a call. We could do a standard short put, or we can do some kind of spread. Hey, I'm kind of blocking that, right? Let's look at each one. The long call has a few pros and a few cons. One of the pros is that, well, with a long call, you theoretically have infinite potential profits, right? As long as the stock continues to rise in price, the call you have will continue to rise in value. The other thing is it's easy to execute. You simply just pick a strike, pick an expiry, and then you purchase the call. The other benefit is that it has a maximum exposure. So if you want to get maximum delta exposure on this stock, the long call is the way to go, unless you just want to purchase the shares on their own. The cons, however, are that you get the additional exposures that come with just purchasing a call. So you're going to be exposed to volatility. You're going to be exposed to time. You're going to be exposed to, what's the other one? We got theta, we got vega, and I guess that's it. But you're also going to be exposed to the price movement, right? So the inverse, so if the stock's price falls, well, you also have a large downside risk as well. And the other thing that is particularly, kind of unique to the long calls is that there always seems to be some aspect of timing. And so I'm putting that in the con category because sometimes I feel like with traders, especially starting out with options, it seems like the long call is always the one that bites them in terms of time. The short put, working through them as well. One of the pros is that once you sell the put, it's a credit, right? You have that money immediately. It's also easy to execute, just like a long call. So you simply just pick a strike, pick an expiry, and then sell a put. One of the cons, however, is that you do have a capped potential to your money, right? So once you sell the call, you get that credit. Or once you sell the put, you get the credit. You can't really make any more money because you've gotten the credit for your position. So you've capped out how much money you can make. We also have almost like an infinite downside risk, right? If the stock's price plummets, well, now not only is our put, the position that we're in, going to lose value, we may be exposed to assignment risk. So we're going to have to sell shares at a much lower or higher price than we may be able to purchase them, and that can weigh pretty heavy on our portfolio. The other thing is we're going to be particularly exposed to volatility, for various reasons. The call spreads here. So what's a call spread? So you will sell and purchase a call at different strikes, and this kind of gives you the ability to profit from an increase in price. And one of the pros is that it caps your losses. So that call that you sold is going to help mitigate your loss in the event that the stock's price falls. Another pro is that it neutralizes all the other exposures, so you only get exposure to delta. So you don't get exposure to vega, you don't get exposure to theta. You only have delta exposure, which is perfect if you only want to capture the movement of a stock's price. The con, however, is that you then now have a capped profit potential. Just like you have a capped loss, you now have a capped profit. So, and one of the cons, I guess, would be execution, because it is slightly more difficult to enter and exit spreads because you do have two positions that you may have to independently purchase or sell. And depending on the broker that you use, this may not be the most easy thing to do in highly illiquid stocks, or if something goes really sideways, you may not be able to exit that spread position, which can put you at some assignment risk and various other things. So the execution for the spreads is slightly more difficult than if you just purchase a call or sell a put. So now that we kind of went over the three, let's say that Sally this time, she goes with a long call because she wants to maximize her exposure to delta. She is highly confident that the stock is going to go up 5%, so she wants to maximize her potential profits from that, and she does so with a long call. The things that she's going to have to look out for as this trade progresses until she hopefully exits the trade or the position, hopefully at a profit, is that she needs to be mindful of the stock's price falling, obvious, of volatility falling, and of too much time passing between price movement. So if the stock's price falls, the value of her long call is going to drop. If volatility drops, the value of her long call is going to drop. And if too much time passes, well, theta is going to eat away at the value of her call. The winning condition is the stock goes up. So if the stock goes up, Sally was correct. Whatever she used, whatever tools were in her kit that got utilized that day to say, hey, the stock is going to go up 5%, she was correct. She used those tools appropriately. And again, the loss is simply if the stock goes down. So if the stock goes down, then Sally knows she needs to reevaluate whatever made her come up with this idea that the stock was in fact going to go up, because, well, it didn't. It went down. So that's EEP-JAWL in a nutshell. And as we progress through some of these examples, we'll see that it's pretty well suited for both the mundane, just buying a call, as well as the more intermediate types of options plays. And honestly, I use EEP-JAWL everywhere. I use it even for my more advanced options plays. So let's look at example number 2. So Sally thinks that liquidity is low on a stock and will continue to get worse. So she thinks volatility is going to rise. She doesn't think that the stock's price will move much in the next month. So she thinks that in the next month, this stock is going to stay where it's at. And as it stays where it's at, volatility is going to increase. So her expectation is the stock's price won't move and volatility will go up. So she wants, what type of exposures does she want? Well, she wants to be able to benefit from volatility going up, which means she wants long vega. And she wants long theta because as time passes over this next month, she wants to benefit from that. She has this insight that the stock's price isn't going to move for the next month, so she wants to profit from it. She doesn't just want to profit from volatility, but again, she explicitly thinks that for this next month, the price will not move. So since she wants to benefit from the passage of time, she wants long theta. And she really doesn't want delta, right? She doesn't want to be exposed to the price's movement because she doesn't think the price is going to move. So there's no reason for her to continue her exposure to that delta. So how would she structure this trade? Because it's a little paradoxical. If we look at the long vega and the long theta components, well, they kind of work against each other. Because long vega comes from long options and long theta comes from short options. So how is she going to long an option and short an option without neutralizing her vega and neutralizing her theta? Well, we're not going to get too much into it here, but it is possible, and one of these trades is called a calendar spread. And with a calendar spread, she's going to sell a near-term strike, and she's going to purchase a same strike, but longer term out. And this is going to give her a net long vega, long theta exposure, and she has no delta exposure because these strikes or the two options are at the same strike, even though they're at different time frames. They'll have relatively close theta or relatively close delta, which helps neutralize her delta to a good extent. So her possibility is that Sally is going to enter a calendar spread. Not too shabby. And as we saw, the justification for this is that she wants minimal exposure to the price movement, but she wants to, can't really see. She wants to profit from this increase in IV. Pop me back. All right. So the things that could go against Sally's position are the things that she's going to keep an eye out for and only for. So it is another, sorry, I keep kicking the desk. This is another good topic to bring up. A lot happens in the market, right? So by distilling down the very unique things that will go against this position, Sally can ignore everything else. So she's only going to pay attention to the large price movement. So if it goes too far away from the strike that she thinks the price is going to stay at, or if volatility decreases. Besides that, I guess if the S&P 500 tanks to 1 million, or tanks to 1 million goes to 0, but if this stock doesn't experience a large price movement, or if volatility doesn't decrease, she doesn't exit the trade. Her winning conditions is that IV increases, right? The whole purpose of her entering this trade is because she thinks that volatility is going to go higher. So if volatility doesn't go higher, the whole premise of this trade is wrong. She misinterpreted the tea leaves, and she needs to go back and get another online psychic degree. Sally has 4, and she's pretty confident in her abilities. Then the losing condition then is if IV decreases. Did I mix that up? So the winning is IV increases. If it does so, she actually read the tea leaves right. So we're already just dogging on Sally needlessly, right? So, but the loss is that IV decreases. So that's going to be particularly the thing that she looks at and keeps an eye out for, depending on her time frame, to ensure that her reasoning and her rationale for entering this trade was correct. Not too shabby, huh? All right, let's get into some interesting ones, right? So, next example, Sally has 1,000 shares of stock X that is currently experiencing a drastic run in price up. Sally has already made significant gains over the past month on this stock, and she would be happy to exit her position right now if she needed to. However, she thinks that there might be one more leg up before the stock starts heading back down, and so she wants to profit from this last leg up before it drops in price, right? I'm a little bit long-winded at times. So how can Sally do this? Well, how can she structure her trade rather, right? So let's look at EEP-JAWL. So her expectation is that she does want to take gains soon, right? She has done well in this pick. It has risen drastically in price with her 1,000 shares, but she does expect that the stock is going to run up one more leg. Maybe she anticipates some point of resistance, or maybe Borex is spiking, or maybe the hedging heat map has significant selling at a certain point, and she's confident that the price is going to head to that point, but then it's going to be quickly rejected, and maybe even rejected significantly, where she doesn't want to be in this stock once it gets rejected. So her expectation or her exposures is she's going to want some long delta exposure, because she's going to want to, and I should have these in quotes, because her position is going to want some long delta. It's going to want to profit from the rise in price to a certain point, and it's also going to want to experience the decay of once that time passes, it reaches that certain point, and then the stock starts to fall. All of that is to her advantage. So I kind of added the idea that she wants this like long theta position because she needs that passage of time to occur. She kind of is, her trade here is dependent on that path of price movement, which is dependent on time. So she has two possibilities. She can short a call and she can short a put, right? If she shorts a call at, say, whatever strike she thinks that this stock is going to head to and then bounce back down, or maybe she even goes a little above, well, she gets that. She gets the exposure, she gets the benefit, she gets the sell money, benefit from the rise in price without it reaching the certain point, and then she gets the benefit as the stock price falls. Or she can short a put where she will be able to sell a put, and then that put her position will gain value as the stock's price increases. As the stock's price increases, her short put's value decreases, which increases the position or the value of her position. And so she really has these two options. In both cases, they benefit if the stock goes up, and short call is a little bit more dependent on it stopping at that particular point that she thinks it's going to stop at. But she's pretty confident that it's going to stop where she thinks it's going to stop. So she goes ahead and goes with the short call because she wants to avoid assignment and her exposure to delta. Because remember, if the stock price does fall, which she eventually thinks it will, the short put is going to have as the stock's price falls towards the strike of that short put, she's going to have to exit because the value of her position is decreasing. So she has both the value of her shares are decreasing and the value of her position is decreasing from the short put. And she has that risk of assignment. So if the strike price the stock's price does reach the strike price at that short put, she might have to sell or purchase those shares rather which is the opposite of what she wants to do, right? She's looking to offload these 1,000 shares, not purchase more shares. So she doesn't really want to sell puts. She just wants to sell a call, do it as close to the price point, a little bit above where she thinks it's going to go. And then once it gets to the price point and starts to fall, she will offload her shares and let the call expire worthless as the stock's price falls. The things that could go against her, look at me again, is that the price falls significantly. So say she sells a call and then the stock's price, overnight, the stock's price drops 10%. Well, this is against her because if she had just sold her shares, she would have profited, but now she's 10% down. And if that 10% is greater than the amount of money she made from selling her calls, this whole fiasco was worthless. She should have just sold the shares. Sally sells shares down by the seashore is what she should have done. The winning conditions is if the price does indeed go up to that next leg and then fall. The losing conditions are honestly, other than the assignment risk from the short put or the stock's price falling very precipitously, Sally doesn't really have any losing conditions here because she's really kind of already set the legwork. She did well purchasing the 1,000 shares of the stock that eventually rose significantly in price, and now she's just kind of trying to squeeze out a little bit more juice before completely exiting this position. But her losing conditions, we can't really say she has any because, again, she's already kind of made a good amount of money from this 1,000 share position. So she can be pretty relaxed in the execution of this play. Not too shabby, huh? Hopefully this is starting to click in a way that it's one of those things where once you kind of work through it, and once you see it in action, I think, like really sit there and 3, 4, 5 days have passed, and you know how we all kind of get when we have an open position, we tend to psych ourselves out, right? Listen to your past self. You did the work, you did the due diligence in this position, so give yourself that respect and that confidence of following your research. And this is kind of really what this stuff does, because when you're looking at a position and, say you go long a call and the next day it's down, the stock is down 0.5%. And how many of us are staring at the candlesticks like, we're zooming in and the bar is getting, we psych ourselves out. The bar is getting bigger and bigger. Well, stop all that. Look at your list, look at your EEP-JAWL and say, the thing that's going against me is like a significant drop in price. Is 0.5% significant? Not really. So I can ignore the stock. Moving on, right? So give your past self the respect of the work that your past self did, right? All right. Oops, a little long one too. I can't even put myself anywhere. All right. Last one. Maybe, I think. Sally has a long position that has a 2-week expiry on stock X that is currently going down in price, similar to what we just said. Due to the day trading rules, Sally can't exit this position, even though she thinks the stock, she can't exit this position. So even though she thinks the stock will continue to go up on this 2-week period, she does want to protect herself and even profit from the event that the stock declines both in the near term and long term, right? So she's kind of being greedy here, but we're going to see if it's possible. So she has this, let's do EEP-JAWL before we even start talking about it. So she has this long-term up outlook, but she's watching the stock go down on the short term. So she has a short-term short outlook because she's watching it happen. And so the exposure she wants is a short-term negative delta, short-term short delta. But the long-term, she's telling us she wants to profit even if the stock does go up for the 2 weeks, or if the stock has started some new trend or some data point has changed and the stock is going to drop. So she kind of has a questionable, not yet decided, TBA, is it? To be announced, long-term delta exposure that she doesn't really know what she wants. So how can she do this? And is it even possible? So if her original position is a far dated and long delta, one of the things she could do if the stock today is red is she could buy a put. Say she buys a put with the same expiry and the same strike as the call that she has. And so she'll neutralize her position. She'll gain that put will gain value as the stock's price falls, even though the call is losing value as the stock's price falls. But the problem is that this just neutralizes her position, and she's effectively spent money, twice the amount of money to do so. And again, we saw that Sally isn't a successful trader because she sits at the sidelines. I think Sally's really common expression is scared money don't make money. And this is being scared. She doesn't want to just neutralize her position. She wants to profit from this. She's watching the stock fall. She knows that she looked at the hedging heat map and she saw it hit some selling pressure, and she knows this sucker's going down. So what can she do? So the point of that is neutralizing the position is not acceptable to Sally. But what if Sally buys a near dated long delta short position? But it's going to be costly, right? But there's a few benefits to this that let's work through. Let's see what would Sally benefit from spending more money, more than she spent on her long position, even though she has a long-term outlook that is bullish. What are the benefits to this? Well, there's 3 outcomes here that we can look at. We can say that the price goes down only in the short term, so the price goes down just like Sally is watching, and then the next 2 weeks the price appreciates as Sally expects. The price could go down on the short term and the long term. So whatever happened today, it changed the landscape sufficiently to where the price is now just going to go down, or the price only goes up, right? Those are kind of our 3 main ways that the stock can evolve over the next X amount of days. Well, if the price only goes down, or it goes down in the short term, because we now have a net short delta position, because we purchased a closer expiry, larger delta put, so we have a net short delta, we're going to profit. We're going to profit from this. So this will help offset the amount of money that is spent to purchase the put, right? And we haven't just neutralized our position, we've actually profited from this short-term decline in price. And the same goes for if the price goes down on the short term and the long term. Well, we have, again, a net short delta position. So we can either just keep this long position open and let it expire worthless, and we don't really mind because our net short delta is just continuing to rise in value as the long position loses value. And then when it's time to close the short position, we just close out the long position. And the net short delta that we accumulated in this put position will help mitigate the loss of this long position. Because again, the long position is going to lose money, but because we kind of forked over that extra money on the short position, this is okay with us. Now, what if the price only goes up? Well, Sally's still actually in a comfortable position. Because that short delta position is a near expiry, she can offload it. So say like the moment she buys a put, how many times has this happened to you? You buy a put and then green candlestick, like all the way up, right? And so what's Sally going to do? Well, she's just going to exit her short position that she just opened. She's going to do so at a loss, but where she's trading that delta that she purchased with a put, like the value of the put that she purchased, even though the nominal value is at a loss, she's counterbalancing that with the fact that her long position is open for 2 weeks. So she has a longer time frame to recap the losses from her short position. Does that make sense? So on one hand, you're purchasing short delta, it's more expensive, but it gives you a greater exposure to this downside. So if the stock does experience a downside, we can profit from it. And this works both if the stock price goes down only on the short term and on the short and long term. But the risk really is that the stock's price won't go down, it'll just go up. Well, Sally still has time on her side because she can just wait. Hopefully over the next 2 weeks, the stock will increase in value more than the cost of the put that she purchased. So she's sitting in a pretty good spot. So the expectations, we kind of have 3, right? And this is a dynamic system. And what's helpful here is we now, when we go through this dynamic system, we have an actual flow chart that we can look at to determine which way we need to go, and the flowchart tells us exactly what to do. But on the near term, she wants negative delta, and most likely long-term positive delta, but also maybe long-term negative delta, or maybe she wants that long-term quote-unquote positive theta, where she wants to be able to benefit from that longer expiry with the 2 weeks of her long position. Pretty nifty. I think it's pretty nifty. So in the near term, Sally's going to go ahead and purchase a high delta long put, giving her a net short delta exposure. The justification here again is if the price declines on the short term, her net short delta is going to benefit. She's going to be able to profit from that, close her position, and then let the long position ride out for the next 2 weeks as the price rises back in value. If the price decreases on the short term and the long term, well, her net short delta will hopefully profit and cover the expenses of closing the what turned out to be wrong long position. If the stock price increases at total, like completely, it just doesn't fall in price at all the moment she purchases the puts, giant big green candlestick, well, Sally again has that time where she can let her long position ride it out and profit. So what would go against Sally's? I didn't mean to click that. What would go against Sally's price movement? And it's simply, or against Sally's position, and really, or rather the thinking of her position, and that would be no price movement at all. She's only in this position because she thinks that the stock is going to go down on the short term, but what if it doesn't? Well, then that tells Sally that she needs to reevaluate. Is she too trigger happy with her anticipation of red days? Was she reading the data wrong? What was going on that made her think that what she's seeing on the screen right now wasn't transitory and was just going to pass? Maybe she needs to work for the Feds. The winning conditions then, again, if she's like, yes, I was correct, is the price goes down and then the price goes up. I don't know. Oops. Oh, goodness. This is going to take forever. No. And then I don't know why the L's not there, but then again, the losing is the price just goes down. And we say the losing because, well, she entered the long call position or the long position with the 2 week expiry because she anticipated that the stock price was going to go up. And then she found herself in a position where she wanted to capture short-term gains while still having a long-term outlook. But if all of that was wrong, if it was just a long-term down, or her entire premise of this trade again was faulty, so she needs to go back and reevaluate what told her that this stock was going to go up over the next 2 weeks. And that's EEP-JAWL, guys. I hope it's helpful. A quick recap, we have expectations, we have exposures, so what are the things that we want, what are the things we don't want to be exposed to, what are our possible options plays. Hopefully today's examples kind of helped navigate how to structure those possible options plays. Then we talk about the justifications for each one, and then which one matches our trading style. That's the one we jump in. And then we want to look at what could go against our position. Then we want to look at what would be considered our winning conditions for this play, not necessarily the profits we want to take. And then we want to look at what would be the losing conditions for this play. And again, not necessarily what could make us lose profits, but what was the overall thinking and logic behind this play, and was it wrong? I want to move me back down. I like down. All right. Sorry. That's earnings. It's not earnings and earnings with deep dive stocks. This is the last video, which you should go watch. I'm gonna leave this here. Go watch it. It's super cool. But this was EEP-JAWL developing a trading system. I hope it's helpful. I hope you can take this, make it your own. But the key take home point here is you should really have a structured trading style, a structured trading flow. And if you don't have one, I highly recommend working on it and use EEP-JAWL as a backbone. I think it covers a lot of the bases. It's dynamic enough to where it can fit a lot of different trading styles and expectations, while not being too dynamic, that it still gives you a nice structure and a nice flow chart for how to do things. So that's all I have for you today. Thank you for joining. I'm Justin from Deep Dive Stocks, and I'll see you guys next time. Bye.